Jeff Fehrman, president of the Fehrman Investment Group, here to cover a wide range of financial topics. Jeff, I always am grateful when you're here because you help break down some complex issues and help us prepare financially, so thank you.
It's always interesting to make the complex simple. That's a challenge.
Well, and not many of us can do it, so thank you for that. And I want to begin with something that's complex. It's our overall economy in the United States. It appears to have had a bit of a slow go of it in 2016. So the question is, what do you anticipate for our economy for the rest of this year and certainly into 2017?
Yeah, and you are correct. If you look just statistically back in the 90s and the 2000s, we were growing our economy on average 3 to 3.5% per year. Unfortunately, we're on a 1.5–2% trend, which is certainly better than we were at back in the Great Recession when we were negative. But the problem is it is a slow growth, so we're adding jobs. That slowed a little bit. And we really want to get back to that 3% range. Obviously, they've talked about that in the election cycle. And we do believe we're going to kind of see more of the same throughout this year as well as next year. We're seeing slower productivity gains with employers. We're seeing businesses continue to grow, but business spending has not shrunk, but it has slowed a bit. Again, that goes into that GDP number. The one bright light has been low gas prices, which is helping the consumer, and the consumer's 75–80% of the economy. So there's some slow growth, but some positives in there too, Brad.
You know, we recently heard from the Federal Reserve that they were going to leave interest rates alone for now. Where do you think interest rates are headed from here?
Yeah, you know, what we kind of deem is we're going to see lower for longer, and let me explain that a little bit more. We do think the Federal Reserve probably raises rates in December or maybe early part of next year, maybe a quarter point. It's not going to be a drastic increase. So I think if you're looking at our clients out there that are looking at their bank accounts, that interest income from the bank isn't going to change drastically in the short term. That's a downside if you're a CD or money market person. The upside is the lower for longer is certainly a positive for car dealers and housing and all those sectors. We just think when you look at our economy, rates are going to go up slow, primarily driven by the fact that the world interest rates are really low. You have places in the world that have negative interest rates trying to spur their economy. So we're actually one of the higher interest rate environments in the world right now. So
if somebody is trying to make a big ticket decision, a house or a car, there's not a lot of pressure to do it immediately interest rate wise.
I would agree with you. You know, I think it would be sooner than later, but I think you have time if you're buying that new big ticket purchase, boat, car, house. I would make a good, wise decision over feeling like I got to rush into it to get the best interest rate. I don't think that's going to be a big factor for them.
All right, so that's good advice when it comes to purchases. What about investments? Big picture here, the market is seeing all-time highs. How would you advise us to invest typically?
Yeah, so right now we would tend to err on the side of conservative, I guess. And, you know, we look at everybody's situation in particular to their stage in life. Are they retired? Are they not? But just as a general trend, we would see a couple things. One is with the election cycle being volatile, we don't know who's going to be president. We won't get into that particular topic right at this moment. But we would tend to be more conservative, so we might have a little more fixed income. We would be more U.S.-centric, meaning if you look historically, if you typically would be 20% international, we might be at 10% now. So more focused on the U.S. We are slow growth, but we're growing as opposed to the rest of the world that's not. So, and we would tend to be in larger companies versus small companies. Again, look at each person's situation, but relative to what they typically be, we'd be a tad more on the conservative end.
All right, we mentioned home purchases a moment ago. I want to talk a little bit more about real estate because that's something that directly affects our viewers, and you're good to always give us your input on it. So what really are the current trends now when it comes to real estate?
Yeah, so real estate's been interesting. The good news is real estate is trending in the right direction, and let's break it down maybe twofold. One, I think locally real estate has been helped by low interest rates, and it's been helped by the things happening at Fort Gordon and other corporations coming in the Augusta market. So I think we didn't have the big dive that a lot of markets did. It did soften quite a bit, but I think we've bounced back because of other internal and external factors, and the U.S. has as well. There's obviously different pockets of that. Although it really, based on where interest rates are, you would think we would be even a more overheated market. But there's still a lot of people renting. You know, the old rules where you could get a loan just about anywhere for any income are gone, which is a good thing, but it's kind of swung the other way where it's really difficult to get a loan. So it slowed the housing market to where it could be, I guess.
All right, let's branch away from the U.S. for a moment, if we will, and talk about what's happening in our global markets. What can you share with us there?
Yeah, so the good news is they're working hard, whether that's Europe or emerging markets, on getting some stimulus in place. That's the reason for those low interest rates globally. We're still not big investors in a big way there because we think they're still behind us quite a bit, and we tend to have a retiree client base, so we'd rather be late than early, in other words, because if you're early, you might be too early and get clobbered return-wise.
From a stock market standpoint, it seems that a lot of times when it comes to the stock market and its connection to politics, we're waiting and watching and being very cautious. What do you think is going to play out when it comes to the political scene and the stock market with the upcoming election?
Sure. So we're getting into something that we try not to get into in the investment world, politics or religion, but it is important, and it's important especially in this election cycle. The interesting thing is, if we look historically, people always say, well, who's better for the economy? And whatever your side is, you're going to argue that the Democrats are better if you're a Democrat, or Republican if you're Republican. Interestingly enough, history says doesn't make any difference. There's been a lot of good markets with a Democratic president, a lot of good markets with a Republican president, and there's been a lot of bad markets with a Republican president and bad markets with a Democratic president. So historically, the driver is not the president, although an interesting one is the best returns have been had with a Republican president and Congress, but the second best returns historically have actually been with a Democrat is president and the Republicans controlling that Congress.
Generally speaking, why do you think it does not matter who controls the presidency? A lot of people think it does. A lot of people are predicting, either gloom and doom or great success depending on who wins. Why do you think it doesn't matter?
Yeah, well, I think everybody predicts doom and gloom or prosperity because it sells time on TV sometimes. But I think why it does matter somewhat, so don't get me totally wrong, but I think it matters less than each candidate is going to tell you, because it's a great talking point. What gets you to vote for somebody? Well, your pocketbook is sure a big motivator, along with social mores and those kind of things, but your pocketbook speaks a lot. But I think the bottom line is two things. Federal Reserve has a lot more to do with the economy than the president.
Yeah.
And then also, secondary to that, from a stock market perspective, corporate earnings, in the long term, you can say all these things move it, but in the end, people pay for a stock based on the earnings on the underlying company. So there's bigger things than just the president.
Well, I appreciate you clarifying that connection and giving us some insight into this political season, because it is coming at us quickly, and
it is.
Someone's going to have that job in a few short weeks.
We're going to have a different president either way.
Right, either way.
It'll be interesting no matter what.
It's coming. Jeff, thank you for your advice. I really appreciate it so much.
Great to be back with you here this fall.
Absolutely. Jeff Fehrman, president of the Fehrman Investment Group. You know who's the president of that group. It is Jeff Fehrman. As we wait to see who the president of our nation will be sure to reach out to Jeff or his team.